So I passed the exams back. The average was good. It was a B, which is good. I always this. So some of y'all might help me with understanding this time of semester, especially once we get halfway. Students start. A few students are like panicking, like I have to pass this class. It's the most important thing in my life, kind of thing. And it gets to the point in the semester where it's too late to do anything because I can't offer one student, oh yeah, you can retake off your exams, because I then have to offer to the entire class and I don't have time to regrade 200 papers. So this is what I would have done as a student and someone who can tell me what I'm missing. So I really got to pass the class. It was the first time I've had a professor. On the first paper, I would have written it and shown it to the professor and gotten feedback because I kept saying, those two things, exposure, experience, that's the most missed thing there is. Second.
Any unattended baggage will be subject.
Never had this professor before, so I would have taken the paper to him, maybe have him look at the entire thing, but at least look at those pieces just to make sure I had those. On the exams, same thing. I would have, well, there was no article on this, so I would have watched the lecture. So you're supposed to spend 2 hours outside of class for every hour in class. So that's 5 hours a week. In this class, you got 3 weeks with nothing but the exam. So that's 15 hours of study for an exam. So how would you do with 15 hours? So I would have watched the lecture. I would have watched it again with the rubric, and then I would have paused it, and I would have written each part of that rubric off the top of my head, so it'd be my own words. Then, since I never had this professor before, I would go into the professor. I wouldn't necessarily say, hey, grade my paper. But I would say, could you look through this and see if there's anything major you see missing? And I'll do that for a student. Make sure I don't like students missing easy points. And this, let's say, you know what, you really didn't explain this well enough, or you didn't do this over here, or I wanted 4 reasons, you really have 3, I would have found those obvious things. The second question, I would have read the article because there was an article. I didn't want to watch the lecture, read the article with the rubric. Again, I would have written each piece. I would have gone to the professor, look through it, see if there's anything major going on. Oh my word, wording interpretation is 1/3 of the question. Did I get that correct? Was that what you're looking for? I would have done that. On the math questions, and I've always done this, I would have taken the class examples. I think I gave y'all 3 of one and 4 of the other. The first week, I would have worked every problem every day for the entire week. So that would have taken me about an hour. The second and third week, I would have picked one problem and just worked it twice a day until I had it. And then the last few days, I might just work that problem once a day. I've always done that. I remember one graduate class I did that. I had the entire problem memorized because I worked it so many times, and he gave the exact same question on the exam, so I already knew the answer. So you add all that together, it really doesn't get more than 10 hours. It's probably about 10 hours of studying, which is, I should have been doing 15. What grade would I have gotten if I'd done all that? So if some students say, well, I did all that and then did well on exam, there's something else going on. It's the way the student. I think part of it is, you got to put the time in. Part of it is you've got to work problems over and over again. Another part of it is I think some students have way too many classes that are mainly multiple choice. And so they study for my class like it's a multiple choice, and it's not multiple choice. Multiple choice, you should never take a class that has multiple choice because it's not the way the brain works. So I've got other theories. I'm not really sure. But if a student spent 15 hours preparing for this exam over the last 3 weeks and did really, really poorly, maybe it's sitting down with a life coach and just figure out, can I use that time better? Because I don't think a student should have done badly with 15 hours. Now, if a student spent 30 minutes or an hour, then yeah, you would have done badly on the exam. There's no question on that. It's a tough exam, right? This wasn't an easy exam. I don't like easy exams because life isn't easy. You got to be able to handle complicated stuff. But it takes some time. So you spend 5 hours a week, and a lot of students did extremely well. So that's my defense. If I had 40, 50 students and they all made really low scores, then obviously I messed up, but a lot of students did really, really well. So some I figured it out. I do think it comes down to time, though, don't you think? Do you think the correlation is between time, or is it not time? Do you think the highest scores put the most time in and the lowest scores put the least? That would be my guess, but I don't have that data. But if someone wants to come and say, hey, I put 15 hours in and I did poorly, we can sit down and figure out what those issues are. You can say I'm too picky, but I think in the class you could tell I was like bouncing off the walls on some of these things, that these are really important things. You might not think they're important, but you kind of have to, you're kind of stuck with what I think is important. I only have 30 years of experience doing this, so I might have some clue. But I don't like students not to do well, but at the same time, students have to put the time in because this is a university degree, you know, it does take some effort and time. So I don't know if it's not effort, if it's something else, I don't know. It could just be you're not connecting with the professor in this class. And in that case, then, you know, I don't know how to fix that. Personally, for me, it's not every student that's not connecting with me. So otherwise it'd be pretty obvious, but I'll give them back. So what I will do in this class, especially, it's a little weird. So you can get some points back, but here's what you can do, and you're going to have to figure this out on your own. Well, I'll tell you before I do that, let me show you some example essays from this exam. So here's a guy named Student. This is the first question. You can see he just followed the rubric. That's the way I would have done it. I would have had titles by the rubrics, because then you're not going to miss anything. Like if you have a rubric title and you don't write anything because you don't know what to put there, then that probably means you're missing something. Capitalized pricing models as insurance, adds shareholder value. He's talking about that, you know, should they actually spending money on that? Expense leakage, he actually put some time explaining that. And then reasons why not, he numbered them so you could clearly see those 4. Does that look like a decent answer? Looks pretty good, doesn't it? Here's another one. What is CAPM? Systematic risk, unsystematic risk, CAPM and insurance. He brought in the table on expense linkage to explain it. Actually multiple times. Why do they buy? Follow the rubric exactly, and there's some substance there. Question 2. So question 2, you had the article, and that article had 85% of what the question was. It really did. I mean, you could have just gone through the article and put it into your own words. It would have been pretty straightforward. What did I add to that? I put a lot of emphasis on the wording side, which wasn't in the article very well. And then we added the storm surge. So that part you had to get out of the class notes, but most of it was there. Since it was open book, you could give actual. So he actually, why is the wording interpretation important? And so went into that. So, you know, again, I think some like, I don't want to use a rubric as my title, but why not? This isn't a paper you're going to publish. This is an exam. So why not just use the rubric? You know, it just saves you the risk of leaving something out. And then on this one, just went through exactly. I mean, it's all there. So you kind of get a sense these papers did well. You didn't have to get everything. I forget what I did. Boy, I can't remember. Oh, so I had all of those in. I added all that up and divided by 0.85, and that was 100%. So if you got 85% of the question right, you got 100. So I was already giving you extra points to begin with. So you didn't even have to get it all correct to get them. So if you leave a question blank, I can't give partial credit at all. So then you're kind of stuck entirely. So I'll put them back to see how well I know y'all's names. So how can you get points back? It's not going to get you to an A or anything, but at least keep you from, you know, disaster. So here's your choice. You can rework 1 for max of 85%. You can rework 2 for max each of 70%. And rework 3 for max each 60%. Or rework 4 for max 50%. So that means if someone really bombed the exam, they can at least get 50% so they can still pass the class.
Oh, sorry, but you can say it. Go ahead. I'm sorry. I didn't mean to interrupt you.
So does that make sense? If someone just really bombed the exam, they could rework all 4 questions, get a 50, so at least they can have a hope for passing the exam. If one person did well on exam and then they bombed one question, they can at least get that up to a B, so they can maybe save an A or B in the class. All right. The 2 math questions we'll have to rework, and we'll see how many people want to do it. We'll have to do it at the end of class sometime, like the last 20 minutes of class or something. So we'll have to figure that out. Or maybe we'll just go downstairs to the FSCs. So we'll have to figure that out. So I got to know who wants. Y'all gonna have to email me and tell me what you want to do. If you're gonna resubmit an essay, you just resubmit it on Blackboard. If you can do a math question, you got to email me because I got to write a new math question. All right, that makes sense. Now I've done this in the past and it's had almost no impact on the grades. So even students that are saying they're desperate, they still don't. I've had people. I mean, I'm missing something. There's obviously I'm an excessive compulsive person, so to me, I panic about every exam and would grossly overstudy in college, but not everybody's like that. But yeah, I've had students like get a 0 on a math problem, come in and rework it and make it a 0 again. And it's like, I don't understand it, because I would think if they don't understand the problem, they come meet with me. Hey, I'm just struggling with this problem, but they just come in, and so I don't understand that because it's kind of takes up my time. There's no help. So I really want y'all to succeed, but at the same time, this hasn't really worked in the past. So hopefully this class will be the exception. There's not many of y'all need it. So if your lowest score is 86, then, or if your lowest score is 84, don't come retake that one question to get it to 85. All right. Don't be excessive compulsive like I am. If your lowest score is an 89, there's nothing for you to do. You're wasting your time. All right. If you have a 92, an 88, an 87, and a 7, then yeah, I'd probably retake that one question. That would have a pretty huge impact on your grade. I worried about doing this in the past because I say, wow, that's going to take the class's average up to like a B+ or something, but it's never happened ever. I don't think I've had more than 1 or 2 exams improve by 5 or 10 points. It's never been. So, you know, I'm offering it out and it doesn't seem to change much, but I'm willing. All right, any questions on that, Kenny?
You showed me a few of those examples of the papers that they written, you know, they actually named like sections and they talked about it. I just thought like you meant to include that in the paper, not literally say this is unsystematic risk, this is systematic risk. Like, you know how you write a paper and you talk about it, it's in there? Because I mean,
well, you'll have to have the title, so all you have to do is talk about it. Yeah.
right, is that what you want? Because for the first paper I did, remember what was it, the floating, the first paper? I didn't, you know, you gave the what to talk about. I didn't clearly name every little section. I just kind of did.
I don't need the sections, but you need to talk about it. The reason I say naming the section helps is to make sure you cover it.
Oh, okay.
It's for your purpose, but no, the section title doesn't add anything or detract anything from the points.
Okay.
But you do have to discuss it. You have to define what systematic risk is. You have to explain what expense leakage means. That's a term I made up myself. It doesn't mean anything, so you have to really explain it. But yeah, no, this is there just to, when I first did it, I've only been doing the rubric maybe the last 4 or 5 years. Before that, I had no rubric at all. People just had to be able to write it out. And I figured, you know, I'm grading off of this, so I might as well do this. And then to my shock, it had almost no impact on the grade, giving the rubric. There's so much stuff that makes no sense to me. I mean, I'm missing something really obvious. I wish a student would explain to me. But yeah, I give you the rubric because I don't want you to leave out something major in your answer. But if I were you, I'd go talk to the professor and make sure I didn't, especially if I've never had that professor before, because, you know, professors are weird people too. No other questions? As far as the essays, you know, you can do it anytime between now and the end of the semester, but I would do it earlier than later. On the math, we have to all do it together because I don't want to go multiple times through that. All right, no other questions. All right, let's so yeah, I was watching Law and Order. They now have Law and Order on the Facebook video feed, which if I ever go, I don't have a TV, so anytime I'm in a hotel, it's the only time I have a TV. That's all I watch is Law and Order. There's nothing else. I don't know if people have 50 channels on cable because there's nothing good on TV other than Law and Order. But they had the one about the lawyer suing the dry cleaners he wasn't the main story, but someone died because it was a pretty crazy story because they delivered his pants to the wrong person. It really wasn't his pants. So they're like saying the lawyer was right, not for suing for 20 million. But I don't know if I were Law and Order, I would do a story about a lawyer that's so obvious his story and make him look stupid. And I mean, what's that lawyer gonna do? He's probably gonna sue them. But anyway, but they did that actual story. All right, so last time we're talking about the liability side of this, and there's a lot of stories about tort reform. We'll talk some of tort reform today. But the defenses are consent, expressed or implied, that they consented to whatever you're going to do to them. That's got to be pretty specific there. One thing, and I've seen this a lot, is waiver of liability. And you probably have had to sign those before. What legal consequences that have? Now, I'm not a lawyer, you can ask your law professors, but I'm pretty sure they're not all that valuable. I think the main reason they do this is to make sure they can prove that you knew this thing was risky. Just the simple fact that you signed it shows that you knew you're doing something risky. That doesn't absolve the other person of negligence. If they're negligent, they can still be sued. I saw it on a truck the other day. It said, "Stay back from my truck. We're not responsible for any damage done by flying objects." Well, yeah, they are. They are responsible. If all you had to do is put a sign on your, I would do that for everything. Stay away from my car. Any accidents this car causes are not my fault. You know, you can't just put a sign up. I remember I took this youth minister on a ski trip because he'd never been skiing. I was thinking, you're working with youth, you better learn how to ski. So they had a waiver, and they had a waiver of liability of gross negligence. Can you have someone sign a waiver for gross negligence? So the guy I took, he was actually pretty good. He was on a black slope the first day. He had like 20 minutes of lessons, and he's like, "I'm ready, let's go." His poor wife, she was not very good. There was one point she was going down a black slope like 120 miles an hour. I was trying to catch up with her. I was like, fall, and she didn't fall. And it was terrible. But signing that, yeah, if they taken him to a double black diamond slope his very first day with no lessons and pushed them off the side, you know, he can sue them. So those waivers, I think the main purpose of the waiver is you're somewhat acknowledging that what you're doing is risky. Does that mean you don't sign? Anytime I sign those, I will write at the bottom, says, I don't believe this absolves you from gross negligence, and I do hold you, and they never see that I wrote all that at the bottom. So I had a gym do that once. I was visiting a Lifeway gym or something. They had a gross negligence waiver. It's like, are you kidding me? If you come over and intentionally drop weights on my head, I can't sue you. Or is that what you're saying? That just doesn't make sense. Contributory is that the person that you injured, they were partly at fault. We saw that with McDonald's coffee. She was 20%, McDonald's was 80%. So it can be the complete defense, but in the US mainly we share between the two. And then what you don't want is for the plaintiff to see that you've done something, and so they intentionally keep going to cause damage so they can sue you. And they say, no, yeah, what I do is wrong, but you could have stopped, avoided all of this. You kept going, hoping you could sue me. So those are your defenses. We generally can't be absolved for, you know, for doing stuff that's illegal. It's hard to sue someone if what you're doing is illegal. So if they gave you some really bad illegal drugs, you know, suing them for that's going to be a little tough. So if it's an intentional liability, like libel slander in the US, all you have to do is prove that what you said was true. It's really interesting comparing. I don't think this will make a good paper too, but comparing the UK on libel and the US, the rules are quite different. It's really pretty interesting. And then finally, you just prove that you weren't negligent. Now, this is for negligence just for the average person out there in the street. When we get to professionals, it changes, the standard changes. So the prudent person is you just have to act like the average person on the street was. Most of us, or all of us, we're going to be a professional, and we're going to make decisions that can cause people to lose money. So, you know, you look at Silicon Valley Bank. Do you think their stockholders are going to sue? I think they should. I think the mismanagement of that bank was pretty gross negligence. They did things most banks, my risk management class, right? We talk about stuff in there. You know, undergraduate student hasn't graduated yet. They would have known not to do what this bank did because, you know, it's pretty basic stuff. Yeah, certainly they can sue. I would sue if I were one of their stockholders. That's that errors, omissions. So you have to think, what are you doing decision wise where what you do would not be widely accepted in your industry. Now, I talk in my risk class, this can be actually pretty bad because it tends to create hurting. Because everybody wants to do the exact same thing. That way you don't get sued. As long as everybody's doing the same thing, and that creates this hurting philosophy. That was what was nerve-wracking to me in 2006 and 07. I did something with USA's pension plan that no one else was doing, made me really, really nervous. Because if anything went wrong, even though I thought the decision was really, really good, the entire employee base could have sued me for billions of dollars and said, well, look, what he did was wrong because no one else is doing that. Now, fortunately, it worked out really well, but it, you know, maybe I was waking up at 3 a.m. thinking, wow, should we really be doing this? As long as you make the same stupid mistake everybody else makes, and I think that's true of a lot in finance and investing, as long as everybody makes the same stupid mistake all together, we tend to be pretty well protected. In some fields, that's probably what you want. If you're going to a doctor, you probably want your doctor to be doing what everybody else would do, hopefully, but there may be exceptions to that. But that's what you're looking at. Most of you, your professional liability is just going to be covered by your employment contract. And if you're not in a management role, you're probably not at risk. As you move up in management, then your firm's going to provide insurance to you to cover that. I remember one board meeting, they were also bored the entire meeting. They were just sitting there making decisions, kind of pretending. And then the guy came in on the directors and officers insurance, and suddenly they all perked up. Like, wait, how much coverage do we have? What is it going to be? What does it cover? And suddenly they were really interested because they're on the board of a $40 billion mutual fund company. That's a lot of money. If you make a bad decision, that people can sue you. So the standard gets a lot higher. So when you talk about professional liability insurance, it's errors and omissions. You should worry about this in your job because if you are making decisions, they can tie back to you. Yeah, there's no reason people can't sue you. If you have your own firm, it becomes much, much more important. You got to make sure you have this type of insurance. I started my own firm. I think we lasted 3 months. I just was too busy. But we had to buy insurance, and it's a few $1,000s. Yeah, it's not cheap, and a big part of that was this liability insurance. I've worked with some people that do they do like philosophical studies, and I don't get worried about it, but if they ever were like to give like psychological advice to someone and they go out and do something, you know, it's like, we need insurance, we need to talk about it. I mean, you go talk to someone. If you tell someone, no, you shouldn't do that, and you're in that kind of this role where you're giving advice, yeah, it can be pretty dangerous. So anytime you're getting paid to make decisions, and a decision you make could cause tremendous harm, you need this type of insurance. So malpractice, errors, mistakes, it covers the insured from professional services. There are these issues of how do we know who caused the problem and when did it happen and was there insurance at that time? So probably the biggest example of that, we're going to talk about asbestos, but one of the most dangerous doctors to be is a baby doctor Because if you're giving birth to a baby, you got their whole life from them to find you did something wrong. And they can come back to you and say, hey, man, you should have done a C-section or you should have done this. And if you hadn't done, so that's a pretty dangerous field and it may take a while for them to figure that out. And that's the other problem they have to do is they got to figure out who was the actual negligent person, who made the mistake. So the explosion doctrine, and we'll talk about that with asbestos, is so tricky. The person, if you're working for someone and they diagnose you with cancer that's usually caused by asbestos, you don't just sue the company you're working for. You got to figure out which asbestos exposure actually gave you the cancer. And if you're 60 years old and you've been working in the field for 30, 40 years, it could be any one of several employers. So how do you figure out which one of those employers exposed you? And then the other question is which of those employers still have money that they can pay you or still have an insurance contract. So some of this is figuring out who has the money. So the manifest doctrine is injury occurs when the symptoms become apparent, but we're gonna, this is the norm. You're gonna get paid by the firm that actually caused the harm. All right, for doctors, let's say they cancel an insurance contract and get a new insurance contract. What does the new insurance contract cover? That could be really, really important, especially if you're a baby doctor and someone can sue you 5, 6, 7 years later. You get a new contract and it starts at that date and the other contract is voided, you got a problem. So you got to make sure your new contract goes all the way back to when you first started doing this type of work. And usually it will. I was talking to one doctor and said, yeah, this is pretty automatic. They're going to make sure they go back to the first day you were giving any kind of coverage. So you go back to that retroactive date. But it can't be, because these things can be over many, many years, there can be a lot of debate about which insurance company is going to actually cover this. And sometimes it doesn't really even matter if you're found innocent, because the press coverage can destroy your whole career, even if you did nothing wrong.
It's true that like with doctors, the big headache with them and insurance and coverage and all that, pretty true, right? Like,
It's what?
with dealing with doctors and medical, like the insurance and being covered and all that's a real headache, right?
Well, it's very expensive. It might be the reason some people are not going in the medical field, because it's hefty. I don't know what well, I've heard some pretty big numbers. Yeah, there it is. Find the lowest rates. Is that really what you want? Free quote.
Doctor, so he knew the Maloney's was always having problems with them.
Surgeons 30 to 50. That sounds low to me. Nurses $100. That seems low to me as well. Surgeons work for big hospitals, but again, they're going to have their own coverage. Surgeons would, to me, be the most risky. Like a general practice doctor probably wouldn't be as risky, but yeah, I mean 30, 50,000, that just seems really low to me, but it's certainly not a $500,000 for a surgeon. It's pretty high.
He would just tell me like you'd always have problems with the Maloney's. I'm like, you're the lawyers.
Yeah, here in town.
Yeah.
I won't say this on the tape, but someone with that last name took my class, and I asked them why, and they said, well, I want to figure out business so I can sue them more effectively. So, okay, this sounds interesting. I'll be really nice to you this whole class. Yeah, so it's a big part of being a doctor, and certainly if you're going to be a doctor, you got to throw that into the cost. You can't say, well, I'm going to make $300,000, $400,000 a year. Well, yeah, you got to subtract that out. That's going to be a huge cost. But your reputation is extremely important. Let's look at I want to give you a sense of what we mean by tort reform. You don't need to memorize this. It's really just to give you an idea. What does the phrase tort reform mean? So what I do is brought some articles. This was big in the news several years ago. So I took advantage of that to bring in several of those articles just so you could kind of see. Not that one. Do the second one. We'll look at that one here in a little bit. I don't know if the fact that it was in the news and then suddenly disappeared, that it really and truly has been solved. But at the time this article was written, like 20 years ago, this is a huge issue in the state of Texas. It's a huge issue, and nationally. In fact, George Bush Sr. was talking about this at the national stage. It was a huge issue. So Congress was trying to pass some tort reform, but of course you got to get the House and the Senate and the president all on board. So they're having tough time doing it. But the states were having much better luck. And so what did Congress say it was? Well, a lot of it was directed at attorneys. So if you're directing something that's going to make attorneys less money, guess what lobby group is pretty powerful? I mean, lobbyists are what? They're lawyers. So what could be worse? You have lobbyists that are fighting their own career. So you're limiting contingency fees paid for attorneys. And this is the issue I was talking about with the Walmart case. This lady gets hit by a truck. She has serious injuries. They sue. She gets her medical bills paid, and Walmart comes in and sues and says, "Hey, we also paid for your health care. You got to reimburse us." I gave Walmart really bad press. But what was shocking to me about the article was how much of the money went to her lawyer. So he obviously sued far too little because she needed a lot more money, but then he ended up with like 60% of the money anyway. I was thinking, Walmart was stupid, but look at this article. The lawyer made more money than his client, and she's the one now that doesn't have enough. So yeah, contingency fees are huge. They give an incentive that may not be in the best interest, I think, sometimes. Time limits, statutes of limitations kind of things on lawsuits. Now, this is a time limit based on once you find out you have a loss and when you file the claim. So with asbestos, we're not saying, hey, you got exposed to asbestos 50 years ago, you can't sue anymore. That's not what it's saying. It's saying you now know you have the cancer and now the time limit starts. So you're still covered. They're not saying why if you got exposed so long ago, you're not covered. You're still covered, but you need to let them know. This is a big one. Punitive damages. This is one I don't necessarily agree with. So the greater of either 250,000 or twice the plaintiff's economic damages or something. Now remember, economic damages includes pain and suffering. So you can get that number up pretty high. But I mean, let's take McDonald's. $250,000 for McDonald's. I mean, they're going to fight that in court, aren't they? I mean, that's going to save them. So, or they may, I don't know, maybe they would sell if it's put on 250. But I mean, that saves them all in trouble. So I don't know if McDonald's, that's all that much of an incentive. Let's say 250. In my life insurance class, we talked about how medical errors is the third leading cause of death in the United States. I'm not sure that's enough. If a surgeon just decided not to wash their hands, if 250 is enough. But that's one piece. Another issue some people are having is they were going after the insurance payments and doubling up. So essentially what they're saying, okay, your net worth is 20 million and you got $20 million of insurance, so let's sue you for 40 million. And essentially the courts are saying, yeah, you can't know about the insurance. You can sue for 20. If its net worth is 20, you can sue for 20. The fact that it is insurance doesn't add on to that. I kind of like that because, boy, that's one thing. When I bought my own umbrella insurance, was like, how much is enough? If they can sue my net worth plus all my insurance, I can never buy enough insurance. So it's kind of frustrating. This was a big one because there was a lot of finding deep pockets back then. So people were like suing Walmart for asbestos. Why? Because there just happened to be some in their attic. They didn't put it, they didn't even know it's there. They didn't manufacture it. They had no awareness that this thing was dangerous. But you see Walmart, why? Because they have money. So what was your share of the actual culpability, not how deep are your pockets? California, similar type of things. Oh, one thing here is try to avoid the lottery. So you give them periodic payments rather than a lump sum, and that somewhat reduces that incentive for the big payout. Again, limiting contingency fees. Yeah, so this is why I was saying is so that number on the what we just looked up. Steep increase in malpractice, which now often exceed $100,000 per year, and this was 20 years ago. So you talk much higher. Physicians in states without malpractice reform are increasingly cutting back on their areas of practice, moving to other states or retiring. So it was having a pretty serious problem, especially OBGYN, and I can never get all the letters in, but baby doctors, they were just disappearing. People are having to drive from one state to another state just to find a doctor because doctors are just getting completely out of the business. So it was causing quite a strain to the whole system. Florida was doing stuff, cap non-economic damages, refusing to perform certain procedures deemed by insurance to be especially risky. So some doctors, again, were just getting out of business entirely. And then you see George Bush in there. He said, this will be, if not our highest priority, it will be in the top 1 or 2. I don't know how you can be in the top 1 and not be your highest priority. During the coming year, I'm for caps. This is what our president said. This is not W. It's what are we? Herschel Walker. What are we? H WH.
I just say
Senior. I'm for caps. If you look at the states that have meaningful caps and you compare it to states like Florida that don't, you can compare insurance premiums. You'll see that was probably the Bush, Jeb Bush there. But yeah, both Bushes were, I think that's the governor of Florida there. But both Bushes were talking a lot about this. All right, here's one we didn't mention before, and that's jurisdiction requires plaintiffs to file malpractice suits in the county where the injury occurred. So what physicians were doing, they're going to the county with the best scores, finding one person and then going to the rest of the country and bringing several thousand more with them to this one court. Why? Because they got really good juries or they got really good judges. And they said, no, you got to file this in the jurisdiction where the injury occurred. You can't just pile on. New Jersey medical liability insurers are lowering insurable limits, and some are offering. So essentially what happened is doctors getting out of business, and then the insurance industry is getting out of business, which is causing what? Doctors get out of business because they can't get insurance. It's kind of like the mold and the mortgage companies in Texas. Nevada, they're still having problems. Southern Nevada has become the worst place in the country for women trying to find prenatal care. And it's just frustrating that people are actually quitting a career just because they can't get the insurance. So you can see all the different states. Essentially, everybody's working on this. I haven't heard tort talked about since then. So we either fixed it or just nobody cares anymore. But I know we still have a shortage of doctors. We talked about that in my life insurance class. There's a shortage of doctors, especially kind of the GP, general practice type of doctors, the specialists. There still seem to be plenty. So that's what tort reform means. I'm not as big of a tort reform because I think there's some things people do that are pretty egregious, and they should pay a pretty egregious amount. But anyway, all right. Let me show you. I'm going to show you another document here real quick, just so you get the sense of what was going on during that time. I'm not sure I would want this judge. I think if I were the I don't know, that's a no nonsense judge, right? That's kind of a Judge Judy judge. She doesn't look impressed with whatever argument they're making. She probably doesn't like this picture on this folder either. It's probably not her. She's probably the friendliest person in the world, but someone just said something stupid, which if y'all watch those shows on TV, boy, it's amazing what people say, and she's just had enough of it. But this came out about the same time, talking about the issue of tort. Tort Tort costs $246 billion, 800, almost $1,000 per person. And what they're saying is tort is growing faster than everything else. I think you could put college education right up next to that as well. But tort costs, the economy, over the last 50 years, tort costs in the US have increased more than 100-fold versus 37 for GDP and population by 2. Growth in tort costs has exceeded growth in GDP by an average of 2-3 points. So the question is why? Where is this coming from? And what this article is saying, there's a big shift, which is the reason you're seeing so much focus on professional liability. There's a big shift, and you can see the big shift. So medical malpractice costs have risen an average 11% per year, 12%. So medical malpractice was, you can see why those articles are so focused on medical malpractice. Other tort costs are growing pretty fast as well. The compound impact is that medical malpractice costs have risen by a factor of 23 since 1975, while other tort costs have grown by a factor of 12. When you grow something an extra 2.6% a year, the exponent growth is pretty intense. Nearly 27 billion in 2003 medical malpractice costs translated. Now, I don't think we mentioned this in my life insurance class. Some people say you got to fix tort to get medical costs down. I don't think $91 per person is going to be a significant reduction in healthcare costs. So it's not as material as you might like, but you hear some people say that. It's the tort system, right? Doctors getting sued, everything. In my opinion is, yeah, they deserve to be sued a lot of times because they do make some pretty egregious mistakes. All right, so what else has changed? First of all, why is this an issue in the United States and not other countries? I don't know what the numbers are. We could probably find it. Per capita lawyers by country. I don't know if this is true or not, but we'll see. Lawyers per capita, United States. One lawyer for every 250 residents. That seems great. Well, we're number 1, so it's good. We're like 40th on STEM and math and science, but we're number 1 on lawyers. Italy's number 2 for 260. Germany next 500. It drops off pretty fast, doesn't it? 516. Romania, that's kind of strange. 800. You get down to the 10th. That's the population. I don't know how far down they go. They may not, maybe they stop. What was the last one they showed? Latvia, every 1,500. So that's pretty amazing though, isn't it? One lawyer for every 250 people. It's not households, it's residents. That seems a little high to me, doesn't it? 250. We have way too many lawyers. Now, we're talking mainly here personal injury lawyers. Obviously, there's a lot of corporate lawyers that have nothing to do with this. So, you know, I don't know if I can do per capita personal injury lawyers. That might be impossible to get. So anyway, but we know the US is unique, is different. So the number of influences, potential legislation reforms, below changes have make the future uncertain. The largest single contributor was a significant upward reassessment of liabilities associated with asbestos. So asbestos was a big one. We're going to talk about asbestos directly here. It's still an issue today. You still hear it today. You still see commercials today. You know, the few times I see TV commercials, I've seen some asbestos legal. So they're still advertising this. We are a litigious society. Reports of class action lawsuits by groups of injured parties and shareholder lawsuits against boards of directors appear in the business media. There appears to be a shift in the types of liabilities that make up the total tort. So this is pretty critical. We went from individuals suing individuals to groups of plaintiffs suing essentially corporations. That was the big shift where you saw that big. So probably the biggest lawsuit tort before was auto claims. People suing, and then, you know, the insurance company gets involved, but you're still suing the other individuals, just the insurance company is is paying their portion. Claims against pharmaceutical companies and their ill effects, and actions against food establishment. So, yeah, I don't think there's been a successful lawsuit against McDonald's for the unhealthiness of their food, but that's always been talked about. It's certainly possible. A number of states have introduced tort reform, as we just saw. All right, so tort, we already talked about a tort, but as a wrongful act other than a breach of contract for which relief may be obtained, either you're going to get money or you can get the other person to stop doing what they're doing. So those are your two. So you can sue someone without getting any money just because you don't want them to build, you know, a 20-story building next to your house or something. It's not a wrong done in our contract. So this is a study done by Tillinghouse. They have not updated it. I can find it. Do y'all know who Tillinghouse is? So I don't know who they all are now. If you're a actuary, I don't know how to spell it. Did they spell it correctly? There you go, Tillinghouse. So used to be Tillinghouse, and then Tillinghouse, Towers, Perrin, and I think Watson. I think there's one other. They all just kind of merged together. But Tillinghouse is one of the premier actuarial firms out there. There they are with Casualty Actuary Society. This is a LinkedIn. Tillinghouse, Towers, Perrin. I would go, you know, if you're still looking for an article for paper 2, I don't know what the WTW means. See if they have research insights. It looks like they have all insights. Rate return, how you benefit. There we go. Does Silicon Valley's banks failure impact asset managers? So they've got, you know, these are great sites. They publish their insights because they're trying to get clients, and that's part of what they do. You know, it's kind of some of my best research is these firms that we use. They have these incredible employees. They got to publish, they're writing, they're doing research. A lot of it's their own work that they're doing, and they just put it into paper and send it to you. You can get some great insights. So if you still haven't found a paper 2, Towers, Perrin, Tillinghouse, Watson Wyatt, that's another one. I thought Watson Wyatt was part of Tillinghouse, and I don't know how to spell Wyatt. Have y'all heard of Watson Wyatt? Does that look familiar? Who are the actuaries in here? Elizabeth, aren't you an actuary? Have you interviewed with them? Yeah, I would. But if I were an actuary, I would want Watson Wyatt, Towers, Perrin on my resume to be sure. I don't see their actual website. There it is. So it's the site. See, that's looks like, I think, yeah, there it is. Willis Towers, Watson. I think they're all merging together. I think it's all one big firm now. So this is a Tillinghouse study before all of those firms merged together. Very impressive firm. So they have a lot of data. They have a lot of actuaries. And so they're doing a study on tort reform because it's hit the news. One thing they say in this study is they didn't look at the benefits or costs or the other costs. So when I was a kid, we had these merry-go-rounds. I don't know if y'all have ever seen those. My brother's a bodybuilder. We could go like 80,000 miles an hour in that thing. It was really cool. If you let go, you're dead, but it was really pretty cool. Those don't exist anymore, although I discovered they exist in Seattle. I was kind of shocked. Seattle had the coolest playground. I almost broke my neck 3 times. It was really fun. I was surprised because that kind of stuff has essentially just disappeared in the United States. So they're not taking that kind of cost of the litigation system of getting rid of stuff that used to be pretty fun and cool, but it was too dangerous. All right, so there's a few more things I want to show. Most of this I think we covered. All right, so they have commercial versus personal. Commercial is alleged against business, including medical malpractice. So commercial includes medical malpractice. Personal is includes automobile accidents is the main one. That's the most dangerous thing we do. The study incorporates 3 benefits. Benefits paid are expected to be paid by third parties. Those are losses. What you got to pay to the lawyers, and then there's some other expenses related to this whole system. All right, so here's an important term right here. This term incurred. I don't think we use that. Have y'all ever used that word before? Maybe incurred. Have you ever said someone incurred a loss? So in insurance, it has a very specific meaning. So incurred, what you're thinking about when incurred is you're responsible to pay for something. And there's a term, probably most of y'all have not heard this term. IBNR, does that sound familiar? What does IBNR stand for? Incurred but not reported. So what does that mean? That means they have to set up a liability. Actuaries have to set up a liability for anyone they're going to pay a claim to, even though they may not know that person exists. Now, how does an actuary set up a claim like that? So there's some guy named Bob out there. He was exposed to asbestos in 1976, but he doesn't know he has cancer yet. But you got to set up a reserve on your balance sheet as for that liability. That sounds ridiculous, doesn't it? But that's what they have to do. How would you set up incurred but not reported? If you're an actuary, obviously you can look at a lot of historical data. You can look at claims that are coming up that might influence that, but this doesn't really exist that much on the life insurance side, but it can be a huge risk on the P&C side. So they're talking on an incurred basis. What's the offset of incurred? It's paid cash. So they're not doing it on a cash basis, they're doing it incurred, which would have given them much different numbers because a lot of the asbestos claims had not been paid yet at the time this article was written. They're just sitting in the reserves. How big are the reserves? You can go back and see probably the most famous one. So CNA, y'all heard of Berkshire Hathaway? So CNA was a big asbestos insurer. It almost put them under. So they paid Berkshire Hathaway $2 billion to take over their asbestos liabilities. Do you think they got a good deal or a bad deal? Whom are they dealing with? Does Warren Buffett make bad deals or do you make good deals? Do you think he took on the $2 billion if it could become $6 billion? Probably not. And this is fairly recent, 20 years ago, 15 years, 13 years ago. So he's taking his own. So we should know now how this kind of worked out. But yeah, CNA, it was funny. A friend of mine analyzes this industry and he was telling me, CNA's CFO came out and said, hey, we've set up, I don't know, $2 billion in reserves or $1 billion in reserves, and we're done. We got exactly what we need. The next year they had to add almost, another 50% or something to that number. That's how much these numbers, is adamant. We've set up enough reserves. We got what we have. And the next year they had to increase it a tremendous amount. So it'd be interesting. I don't know if this would make a good paper too, to see how Berkshire Hathaway handled this whole situation. There are articles written about it. So it would be an interesting analysis. But that's what incurred means. We recognize that more estimates of cost must be used when measuring on an incurred basis than when measuring on paid. Paid is a lot easier because you're just looking for checks that have actually been written. Incurred is much more difficult. All right, defense costs can be really, really tricky. So there's two types of expenses related to defense, ALE and ULE. So LAE are those adjuster expenses. They include lawyers, they include adjusters. There's ALE and there's ULE. I think they're reversed. I would have called them the opposite. So defense costs reflect costs directly incurred in the defense investigation of the claim. Those are known as allocated loss adjustment expenses. And then there's also general handling costs, and those are called ULE, unallocated. So I don't like the titles. To me, I would have called it ALE for the general, and I would have called it direct or something else for the others. So what does that mean? Well, you have a lawyer that works for an insurance company, and their job is to defend these type of claims. That lawyer has a boss that has 40 people working for them, and 10% of their time goes here, then that's going to be the ULE. So it's that, to me, that's allocated cost, but they call it ULE, they call it unallocated cost, right? So they're incurring they're including some costs that are subjective and a little bit debatable. Administrative expenses reflect expenses other than defense costs incurred. If I have anything else except for one more definition I want to show y'all. Yes, as we said, it doesn't include litigation avoidance. Now we talked about this in my life insurance. I think Josh, you're the only one that was in that class, right? Anybody else in there? Brandon, were you in there? Yeah. Okay, so a couple of y'all. So we talked about that of defensive medicine, running tests you don't really need, just because you don't want to get a lawsuit. How much does that cost? I doubt it's a huge number, but there is some debates about that. So unnecessary duplicate medical tests, to the difference of certain products or whole industries from the marketplace because of the high product liability costs. Those costs they're not putting into their study. And there's one other place I want to show you some definitions. Oh, here. No, not there. It's coming up. You can see how they broke it up. And some of them, they didn't have the breakout until the 70s. All right, here we go. So there are some terms in here we're going to see a little bit later, but I just bring them up here. Why is this important? So I'm going to talk about this in my risk class. Too many my finance majors and actuarial majors, but finance majors, it's like I'm in finance because I don't like the accounting. And they're going to be really shocked when they get their first shot because you're going to have to know the accounting. So a good example I'll talk about in my risk class is Silicon Valley Bank. We're talking things like held to maturity, available to sell, fair value accounting. What's the term? I can't remember. Permanent impairment. These are things that have a huge impact on how Silicon Valley reported its numbers. And once you see Silicon Valley, then you start looking at other banks like Bank of America, and you go, "Oh my word!" There's some other banks, big banks out there with some huge losses, but they're not talking about because they're held to maturity. How many of y'all studied held to maturity in your accounting classes? I haven't found a student yet that even addressed that. It's a pretty important concept, but you don't see it at all. So in insurance, it's the same thing. There's a lot of terms in insurance you don't see anywhere in undergraduate. So I used to tell finance majors, take some extra accounting classes. You need to learn accounting, but I don't say that anymore. Take the accounting classes, because what you really need to know is going to be so specialized and industry focused that you'll never get it in undergraduate. They have to keep undergraduate fairly high level. So you're just going to learn it on the job. And that's what I did. I learned these terms on the job. But they have something called an earned premium. We'll talk a little bit more about that. But we need to understand the difference between an earned premium and a written premium. So we'll get into that. So written premiums are very similar to earned premiums, but they're not the same. The loss LAE ratio, we already saw that earlier when we did the Berkshire Hathaway article, when we talked about the combined ratio. The loss and LAE ratio are the losses, the claims they actually paid out, And the LAE, remember LAE is ULI and ALI, so this is both of them together. And here's the expense ratio. When you add these two together, what do you get? I mean, when you add these two together, what do you get? Combined ratio. You remember the combined ratio from Berkshire Hathaway. So they're showing combined ratios. Now it's a little confusing from this chart, but you can't, if they did the chart correctly, you can't just add up loss and LAE expenses, dollars and expense dollars and divide by premiums and get the combined ratio, because these use different denominators. One uses written premium and one uses earned premium, and you don't have written premium here. So it can make a difference. Why does the industry do that? Well, because written premium is the risk. Written premium means that's when we agree to take on this risk. We haven't earned it yet. We haven't provided the insurance, but we said if anything happens in the next year, you're covered. If that happens in December, 100% of that is written. Only 1 month has been earned. And so that's the distinction. Loss and LE focuses on written premium. Expense ratio focuses on earned premium, but here they're showing you the earned premium. It is true the two ratios add up to the total, but if you take the two denominators and divide it by earned premium, you won't get that final number. And then insured tort costs is essentially saying tort costs that the insurance industry had to pay. So it's similar to what we talked about with like flood. You can have catastrophe losses that are 40 billion, but how much of that was actually insured? And so not all tort costs are insured. There's in fact a lot of tort costs, people getting sued where they don't have any insurance backing them up at all, especially on the corporate side. So you can see the numbers, you can see. So this article was written here. You can see huge losses. Back here in the 80s, do y'all remember why these high loss combined ratios might have been okay in the 80s? And you remember that? High interest rates, right? So that can explain some of that, but not necessarily high interest rates here, but really high loss ratios because of the tort issue going on. And that's the reason you suddenly saw all this coming up. There's the personal lines, the commercial lines. They're breaking some of those up. They have a little bit more detail. Now, where can you get this details? So when I was at USAA, we had access to something called SNL. You might ask for this. I know SNL is, if I just said SNL, probably something else would come up. So it's like everything else, it was bought by Standard & Poor's. It's a really good database because it has all of these numbers. A lot of these numbers are statutory numbers, which means they're not on the GAAP financials. They're only filed with the states. But what SNL has done is they've gone out, because insurance companies have to file these electronically. SNL went out and built a piece of software that pulls all that statutory data. And all of this detail that you're seeing here, you can get all incredible, probably far better detail than what's shown here. You can get really incredible detail from that. So if you go work, let's say, Elizabeth, let's say you get a job at USAA and you need some of this data, USAA probably has the SNL database for free. You just got to find it. So go figure out who that is. I use this all the time. It was absolutely amazing. In fact, there's one point where we're about the only ones who had this, and my boss was really good about volunteering my time to anyone who needed it. And so he volunteered my time to the regulators, and they were writing new laws, and they want to know how many companies failed the law. And I said, yeah, I'll provide that information. And so I was working long weekend hours, so maybe it wasn't so good we had it, but it gave us quite a bit of control over some of these laws passed. There was one point, I think I've told some of y'all these stories before, but Moody's, the rating agency, called me and said, we have a new capital model. Can you run the data for us? And I was like, oh, you're going to give us your capital model first before anybody else? Yeah, I'll do that for you. So having your hands on this data is pretty good. I had an intern that I gave him his data. I was really interested in the investment portfolios of all our competitors, and he was a great, I don't know where he is now, but he was great. He got his hands on it. So just be aware this data exists. We'll look at it later. GAAP financials are pretty limited in what they provide. Statutory provides a massive amount of detail at a really, really granular level. You can do a lot of analysis out there. I've checked to see how much of this data is on the Bloomberg machines, and some of it is out there, like a combined ratio. You can get some of it. I'm going to show you Schedule P later. Schedule P is my favorite. There's so much stuff there, and very little of that is on the Bloomberg machines. So you need a database like this. More than likely, if you're working for one of the large insurers, they have this data available for free, and you just got to tell them that. USA, any USA employee could use this database. They just had to know how to log into it. If you don't know it exists, you don't know. So make sure in your first job you're asking about this kind of stuff. USA at that time had a media department. They had like a corporate library. I don't think they do now. So I don't know where you go. When I was there, you just called Brian. Brian was a good friend of mine. I just called Brian, but he's not there anymore. He went with Victory Capital. So I don't know who you talk to at USA now. So you just have to go around and just ask people where the data is. The shame is a lot of firms have this data and their employees don't know they have the data, so they're paying for it and nobody's using it. I don't think I could get UTSA to buy this database, but maybe I should ask again and see if they're willing to pay for it. It's probably pretty expensive database that we would not use very much because it's so specific. You'll notice with SNL, they have insurance. They also have a bank database. I think most of the bank data that they have is available on Bloomberg. Now, I haven't tried Capital IQ, and I don't know what Capital IQ has. That's an S&P product, so maybe I should try Capital IQ for the insurance data. Maybe some of it's there. I don't know. But this is incredible because I need to break up we had 13 or 11 competitors. I want to know exactly what they were buying. I brought in 113,000 securities on these, and I was able to write a program to say, you know, what the duration, what the credit quality was. You know, I got all that. Now, back then, our computer Excel, I think, only went like 1 million lines. I mean, I ran out of Excel. I had to use multiple files because I kept blowing up the machine. Today, it would be a piece of cake. You'd have no trouble getting all that data in there. So just be aware, you can get, that's where they're getting this data. They didn't go out and do a survey of companies or anything. They just got it right off of this database. I don't know if they tell you where the database data came from, but all right. So you can see in this class, what we're doing is we're hitting those biggest issues from the last 20, 30 years. If a new one comes up, I'll add it in there. But yeah, we're hitting those major issues. All right, let me get back to general levy. Okay. All right. All right, so let's jump back into, oh, well, it's 7:15. All right, so we'll start here. And then next time I am going to finish up this and talk a little bit. There's an article out there on asbestos. It's highlighted, so if you want to read through it in advance, that'd be fine, but we will go through it in class, so you don't necessarily have to, but it is out there. It's called, it's pretty obvious. It's called Asbestos Article. All right, so we'll walk through asbestos and all right, so that's it. Thanks. Just real quickly, I saw this article. I don't know what y'all are doing for paper 2. I don't know how many of y'all own a Tesla. I don't know how many college students own Teslas. Maybe not a whole lot. But full service driving. So that's a little different term than autonomous driving, autonomous vehicles. It's a beta update. You don't want to see recall issues when you're talking about self-driving, but a huge update to its full service driving software. Addressed the big recall that the the National Highway Traffic Safety Administration issued. As a primer, Tesla Autopilot is a highway driver assistance feature that comes standard. So is that where we're going instead of autonomous vehicles? And then the question is, what will that do to frequency and severity of crashes. Autopilot can also steer and mark lanes using the traffic aware system. Enhanced autopilot can be bought as an option or subscription, adds auto lane change, navigate on autopilot, auto park, and other features. Offers the features Autopilot Plus, so FSD. So they're making a distinction between Autopilot and FSD. FSD's beta software, which has around 400,000 vehicles, is often in the program, allows for autonomous driving from destination to destination, is entered in the car's navigation system from end to end. All of these systems require full driver attention and hands on the steering wheel. I mean, what's the chances that's going to happen? Maybe for the first, 3 weeks, and yeah, it's pretty obvious. Now I don't know what police are going to do. They're going to start issuing tickets because someone doesn't have their hands on the wheels. So, it's interesting. Is Tesla the only one doing this, or the other car dealers doing this? Y'all know? There's like Lexus,
Audi, pretty good.
like, do they?
It's not fully self-driving yet, but.
Do you think there's people driving end to end with not paying attention at all the entire trip? There are people out there doing that? Yeah. I mean, so the question is this good for the industry, or is this bad for the industry? And the actuaries are studying it. This is a pretty big deal because if it works for Tesla, it's going to take over the industry. But yeah, it's interesting to me. The initial articles were all saying how this is wonderful because human error is such a big part of that, but we don't have that much experience with cars driving themselves. Okay, I want to talk about asbestos. So you can see some similarities on this issue that we saw with mold. This is on the commercial side, though, where mold was on the homeowner side. So asbestos is a product that was usually used like an insulation, real heavy use, especially in the 70s. And millions of people that were in the industry and put this into buildings had occupational exposure. So we're talking about people who had pretty intense exposure to asbestos. We're not talking people who just, their school has some asbestos on the ceiling and they're a student there. We're talking about people that have their hands in this stuff. Unlike mold, it is conclusively linked to, remember with mold, it was kind of questionable. Maybe a few people have exposure, but here there's really no question. So, but it's the range. So this is where the challenge with this asbestos is. There are people who've been exposed and they have some diagnosis, but there's no signs of impairment. So they're essentially living their life normally. But if you did a test on them, they could show they had something. So obviously people that are dying from the disease, lung cancer, and then mesothelioma. The biggest issue with this is the latency period. Your exposure to the point in time you actually have the disease can range from 10 to 50 years. So that means there's still cases coming forward today. Now, I don't know the use of asbestos outside of the United States, if it's an issue in other countries. An individual victim's disease is typically attributed to exposure to multiple asbestos products over decades of use, and it is virtually impossible to isolate a specific exposure. That's another big issue with asbestos. How do you know who's liable? Who's going to have to pay this claim? So a single claimant typically files suits against 60 or more defendants. Thousands of companies have been named as defendants. Some were major producers. Obviously, if you're producing asbestos, you're out of business. And then once they're all out of business, now you're looking for who's left. The property casualty insurance industry is covering these claims because this is a general liability issue that they got to cover. Our workman's comp claim. So RAN, you'll see RAN in a couple of places, I think, this semester. So when this became an issue, the claims, 730,000 asbestos claims filed against 8,400 companies. So it's quite a few companies. And then the number of claims started increasing quite dramatically. But here's I think the key for why this whole thing blew up. The later claims were non-malignant industries accounted for most of the growth. And why is that? Well, the key, you got to get into your notes. I forget how I asked the question on the exam, but the key is combining all these into a class action. Do y'all know the term class action lawsuit? So you got a bunch of people on one lawsuit. And that's the main culprit for making the claims increase so dramatically. Why? Because it makes it really hard to defend. If you have hundreds of people in the same class, you can't go person by person by person. And so a lot of people just settle to close it down versus the really injured people. That's when you fight. You say, no, you weren't exposed. We're at my job. You're exposed in another job, and there's a big fight. Why? Because it's millions of dollars. With these class actions, you just settle and get it off the plate. So you have to pay your lawyers and get it done. So the studies show that at least half of the asbestos claims were related to non-malignant conditions. That doesn't mean non-malignant is without any signs, but it's not as dangerous and as obvious of an issue as the initial claims. So more efforts. So what are they trying to do? They're trying to get more to the sickest claimants, a decrease in claims filings for less severe conditions, and then more scrutiny for actual fraudulent claims. So there are fraudulent claims here, obviously, of a large class action. So Manville is the first firm that this became an issue because they manufactured asbestos. And you may actually hear their name associated with the trust that pays out these claims. They were the largest manufacturer of asbestos containing products and the largest supplier of asbestos. Does that sound like a firm that's still in business? Probably not, right? They set up a trust which was formed to distribute limited assets among current and future asbestos claimants who were exposed to their products and began paying claims in 98 and 88. Many believe that the increase in the claims reflects greater medical awareness and diagnosis, as well as increased claimants' propensity to sue rather than increase in the disease. So it's not like suddenly asbestos has become worse. It's that people are more aware. I mean, right now, if someone's diagnosed with mesothelioma, you're just told, hire a lawyer. You need to sue. I mean, it's just so obvious. I think I showed y'all in the other article. Actually gave you a mesothelioma commercial. I don't know, I have to hit that twice. So here's an actual ad, 1-800 number. If you or a loved one has mesothelioma, the disease is a result of being exposed to asbestos. They don't say the result might be, they say it is the result of being exposed to asbestos. You may have a right to recover against those manufacturers. Many of the responsible companies have set aside large funds, and many of them are insolvent, to compensate people injured by asbestos products they produce throughout this century. But come to us quickly, there is a statute of limitations. Again, the limitation is not from the point you're exposed, but from the point you're diagnosed. But they're talking to people that have been diagnosed, and they're telling them, hey, if you've been diagnosed, the clock is running. You have to be able to prove somehow that you had exposure to asbestos. And then there's going to have to be some work to try to figure out who is the responsible party. So it's not easy, but if you have mesothelioma, that alone is not grounds for damages. In order to establish a claim, it must be established that you've been exposed to the specific asbestos product at a specific location. That could be tough. If you do not remember the name of the manufacturer or the particular asbestos, we can help. So there's lawyers specializing in this, obviously. All right, we'll get into this after we do the article. Now, I remember seeing a commercial not too long ago on this exact same thing, a lawyer advertising mesothelioma coverage. So there's still advertisements out there because there's still people, the latency period. So, this stuff started happening in the mid 80s and you got 50 years. So this could be going on into the 2020s, 2030s, that people who are just now finding out that they've been exposed and they have the cancer. So, so the change in the number of claims, you can just see the high growth in the non-malignant claims becomes the majority of the claims, 1,300 out of the 1,497 expected. Asbestos is dose dependent, so serious asbestos claims might decline in the future. Really, the people that are most exposed are probably going to be the ones that are going to be have life-threatening illnesses first. Some non-malignant claims are life-threatening. Most claimants with non-malignant conditions do not exhibit signs of impairment. Non-malignant claims are generally influenced more by factors affecting litigiousness, such as recruitment efforts through media advertising and mass screenings. And we'll talk about these mass screenings. There's definitely some fraud going on here. We saw the same thing with mold, right? With people going in and inspecting the house and say, "Oh, you got a lot of mold. Let us gut your house, and you can pay us $50,000." Many of the asbestos producers have filed bankruptcy. The asbestos litigation system has been an ineffective mechanism for providing compensation to victims. Defense transaction costs consume approximately 30% of total payments. That to me is still just ridiculous. How much the legal side gets out of this. 29% to cover plaintiff attorney fees. So we're up to 59%. Only 41% actually goes to the claimant. So over half the money is going to lawyers, some of it to the personal injury side, some of it to the other side. So 59%, 41%. Can we fix that some way so we don't have to involve so many lawyers? So these reforms kind of happen all at once. This was kind of playing out, and that's why I don't think I may have the Wall Street Journal article. We'll see when this all hits the fan. As a result of these reforms, asbestos litigation in these states will likely change to a more individualized process involving single plaintiff claims by the most severely injured. So getting rid of the class action, changing rules about venue. You can't just sue anywhere. You got to sue where the claimant was actually exposed. Tightening restrictions regarding connection between the plaintiff and the venue. Other state reforms relate to innocent sellers. So you can't sue Walmart just because they might have had asbestos in their ceiling at one time. Successor liability and caps on non-economic and punitive damages. A lot of the stuff we saw with the tort reform, medical malpractice, you're seeing that type of same thing. And this is going on somewhat at the same time. All right, let's look at some of this fraud. Plaintiff attorneys in asbestos and silica lawsuits have tended to combine large numbers of claimants in a single lawsuit, making it difficult and costly for defendants to assess the validity of each claim. Many of these claimants have been diagnosed through mass screening programs. Now, mass screening program and people doing the program benefit, the more people they diagnose is not a good incentive to set up. So recent events have cast considerable doubt on these diagnoses, and you'll see some of this. There was a study published called The Diagnosis of Some Physicians and the Questions in the Study. Independent radiologists reviewed 500 chest x-rays that had previously been entered into evidence. The independent radiologists found abnormalities in 4.5% compared to the original 96%. Does that sound like there might be an issue? 4.5 versus 96, plus or minus 90%. Although it's highly unlikely for some, and then the other one is it's unlikely for someone to have both of these. silicosis and asbestos, I can't pronounce these words. It was found that some doctors had diagnosed individual claimants with both. More than 50% of the claimants had previously filed asbestos claims with the trust. So there's Judge Jack. This is the one that kind of destroyed this whole thing. These diagnoses were driven neither by health nor justice. They were manufactured for money. The Wall Street Journal loved Judge Jack. They wrote quite a bit. Yeah, boy, I should have kept that article. I don't think I have the Wall Street article, but you've seen Wall Street Journal editorial pages. I mean, it was, she got an entire page from the Wall Street Journal. It was, they loved her. I don't know if the New York Times wrote about her, but the Wall Street Journal, she was their hero there for a few editorials. Her decision is likely to lead to higher medical evidentiary standards for silica as well as asbestos claims. The impact of this heightened scrutiny in conjunction with stricter medical criteria adopted by some states in the form of inactive active dockets or legislation might lead to fewer mass settlements of pending claim inventories and will likely affect whether and how mass screening activities are conducted in the future. So again, you're seeing something just like mold, just like tort reform, asbestos. You're seeing something that was a major issue for the industry, and it's been resolved. So I'm kind of looking for what's going to be the next major issue for the industry. We keep hearing these hints. We talked about fast food selling unhealthy food. That hasn't become an issue yet. So I'm keep waiting for the next one. These are the ones that the last 50 years have been the major ones. They show you the trust where you can see the claims. That's the Manfield Trust. And here's all the companies and the year they went bankrupt. Quite a few companies. And there's the original one, bankrupt in 1982. You see several of these in the 2000s, and this article was written in the 2000s. So, yeah, number of bankruptcies. So, big issue. Not an issue USAA ever addressed because this is all on the commercial side. This is not individual. So you're not going to sue someone under their homeowner policy because you got exposed to asbestos in their house. I don't think there's ever been a claim like that. So pretty unlikely. All right. So again, addressing this, the Cato Institute. I forgot to mention the Cato Institute. Any of y'all follow Cato at all? Very libertarian. But they do some great research. One of our former students, I don't know if y'all know Corey DeAngelis, anybody know him? He could be Secretary of Education here in a few years. He's making huge waves on the education reform side. But he worked for Cato. He's the only person I've known that worked for Cato. A great organization. I had a project one of my classes was working on. So I emailed Corey and say, hey, this is a good Cato question. And he sent me some names. I emailed them and they were very responsive. It's a great place. But you put terms in there and you'll see what kind of articles they have. Oh, they're gonna make me subscribe. So you may have to subscribe in there. The National Flood Insurance Program, Congress's Samaritan Dilemma. Here's something Cato has. So once you pick your topic, I would encourage you to go to cato.org and see. It's obviously going to be very libertarian, so it's going to be, anti-government and are pro-business, but they do really good research. They're very logical, very data-driven. In my life insurance class, I don't remember, Josh, I used that one book on the health insurance written by Cato, which is a pretty amazing book. Just the data they had on Medicare fraud and what's going on. They're very good researchers. A lot on healthcare in what they're writing. There's one on the pension plan. Some of these are kind of dated. Health insurance, a lot of health insurance. Insurance as gun control. How insurance substitutes for regulation. So really interesting articles. We might use one of their articles later. It's a little bit dated. Some of these are pretty dated. I don't know if you can sort it by date. Past 6 months. Pandemic mortgage forbearance design, libertarian land use contract, not criminal law. The minimum wage undermined, whatever that is, in Massachusetts. Yeah, there's some recent ones, but they don't look specific related to our class. They will write articles on things like autonomous vehicles, regulations. They probably have an article on flying cars. I don't know if y'all seen those things. They're pretty. So now we're into autonomous flying cars. Have y'all seen those things? People are getting around New York City, not poor people, but the top 1% are getting around New York City in autonomous flying helicopters that are saving them, for quite a bit of money. It's saving them a few hours a week. But so they'll write stuff like that. They're very pro on, allow more of these things to happen. It's innovation. And yeah, some people are going to die, but big deal. That's how we progress as a society. So they're a little more blunt. So they've written an article, or they've addressed this issue. So 2 decades ago, they were predicting litigation of about $1 billion. It might go another 38 billion. And then they said it's been about $1 billion. It's going to go to 38, and then it passed 54 billion. Could be 210 billion. It just keeps getting higher and higher. They've stayed roughly constantly over the decades. So it's not the increase in cancers that's causing this. It's the non-malignancies that have jumped dramatically. So the costs are not coming from the most seriously injured. They're coming from the least seriously injured, including many plaintiffs that have no evidence of injury. Forbes magazine said asbestos defendants are very likely now paying compensation for every occupational disease known to man. Incipient or marginal asbestosis, as picked up by X-ray, bears at least a superficial resemblance to more than 130 other lung inflammations, including scores caused by various airborne particles. But the potential of a huge payday impels the trial bar to find clients, irrespective of the validity of their claims. Even some plaintiffs now recognize they are being used. Last year, more than 2,500 litigants. I love this. When the litigants sue their lawyers, charging that the latter viewed their clients as mere inventory that could generate enormous legal fees with relatively little effort. 2/3 of the dollars paid went to those cases, even though many, if not most, of the plaintiffs were not sick in any meaningful sense. Another problem is that the search for deep corporate pockets, 6 corporate companies with no responsibility for causing asbestos. These defendants now account for $6 out of $10 spent. So strategy includes we already saw this, proof of injury. That seems pretty obvious, right? Proof of injury. But if you have 100, 200 claimants, could you have time to go through each one of individually? Ensuring reliability of medical evidence. That's what Judge Jack said. We shouldn't be paying any claims unless there's very specific evidence that asbestos was the cause and that there was serious injury. And then, like we saw in tort reform, limiting the punitive damages. So huge issue. Still an issue. You'll still see these liabilities on the books of insurance companies. All right. Let me get back to our class notes. Have y'all heard of mesothelioma? Is that a term that's commonly? I wouldn't have known about it if I wasn't in the industry. Huh? Oh, but they're still going. Are they local commercials or are they more kind of 1-800 numbers? And yeah, so we'll talk about workers' comp. I don't know how many, and that's kind of the issue here is how many of these are workers' comp versus general liability. So my guess is a lot of them are probably workers' comp because these are people getting injured on the job, and we'll talk more about workers' comp. All right. So asbestos is, the biggest example of general liability or workers' comp, depending on where it goes. General liability protects the insured against liability rising out of their premises, very similar to homeowners. You have bodily injury, defective products, that's where you're not like homeowners insurance, and then personal advertising injuries, false arrest, malicious prosecution, so those type of things. So bodily injury, property damage on the premise are due to their operations. Things like product recall are not covered by this. And it can get a little tricky distinguish between workers' comp and this kind of thing. If you have a worker, say for Xerox, if they still exist, someone working for Xerox and they're making copies and the Xerox machine blows up, is that a product liability or is that a workers' comp? So it can get a little tricky who's responsible for what. And on the personal side, false arrests, again, you have to have damages. So if someone delays you for 10 minutes, you can't go sue them for $1 million. So you have to be able to show that you had actual, but false arrest is possible. Malicious prosecution, wrongful entry or eviction, libel or slander, obviously can be a big one. Violations of personal property, keeping people's stuff that you shouldn't, medical payments. So, I've never been injured on someone's premises. A lady that worked with me, she got out of a car and a limb hit her in the head and caused no damage. And someone caught her on the way in and offered her money and they paid her. She's like, yeah, there's nothing wrong. It's like, it's kind of crazy. I wouldn't accept the money. It's like, come on, things happen. It's kind of crazy. I remember another time, I may have told you all this, when the elderly woman was walking to USAA, did I tell you all that? And she slipped at the entrance and boy, we were down, Tanya was down there in 12 seconds. It was pretty amazing. So yeah, you're going to cover their medical bills, and then you can't have other costs in addition to that. All right, we covered tort pretty well here. We covered the other article pretty well here. We covered the medical malpractice and asbestos. So a lot of this is notes from the articles. Oh, the articles use the word ultimate. So ultimate is the same thing as incurred. So incurred is ultimate. So you want to add together all of your claims into the future, and you want to do it in a way that reflects inflation, but also reflects time value of money. So this is something we saw in the original article from Berkshire Hathaway. So let's go back to Berkshire Hathaway. What happened to my mouse? All right. All right, so I don't think this is it. Okay. So loss development, I don't know if y'all remember this, but in insurance accounting, bad terminology is the enemy of good thinking. When companies or investment professionals use terms such as EBITDA, so he's not an EBITDA person. I don't know why. To me, EBITDA is not like a horrible thing. I prefer cash from operations to EBITDA, but he doesn't like it. But his main point is on the reserving side. In insurance reporting, loss development is a widely used term. He doesn't like this term, and one that is seriously misleading. The loss reserves at an insurer are not funds tucked away for a rainy day, but rather a liability account. It's the money that they believe they're going to pay out. So his big question is, how do you do that? So let's say, talking about asbestos, you may pay this out 40 years from now. 40 years from now, the claims are going to be much higher because of inflation, but you're going to invest the money until then. So, the industry is going to argue that you take that inflated number 40 years, but you discount it at the investment rate. That's what they're going to argue. He's saying they shouldn't be allowed to discount those losses. Well, that's going to be a pretty serious problem. Because 40 years out, that's gonna be a massive number. If you put that in today's terms without discounting, it's gonna overwhelm the firm. So I don't think I agree with him here. Now, he's an auto insurer, so his, he's talking claims that last 2 years. If properly calculated, liability states the amount that insurer will have to pay for all losses that have occurred prior to the reporting date, but have not yet been paid. When calculating reserves, the insurer will have been notified of many of the losses and some not. So we talk about IBNR. It is clearly difficult for an insurer to put a figure on the ultimate costs of all such reported and unreported events, but the ability to do so with reasonable accuracy is vital. Otherwise, the insurer's managers won't know what the actual loss costs are and how those compare to premiums being charged. We're going to actually do this. You're going to see real quickly why I love Schedule P so much when we get into the math of the accounting. Schedule P is going to tell us the mistakes they made. That's why I love Schedule P so much. You're going to actually do some math on the second exam where you'll not only will you see how much did they misreport expected losses, but how did that impact their net income? And you're going to see with the insurance companies, these loss developments, these changes in reserves, they're not like 10% of income, 20, they can be 80, 90%, 150% of income. Firms make, it doesn't look like a big change. You go from 6 billion to 6.3 billion. So you add 300 million, but when your net income's $1 billion and you add 300 million, that's 30% of your income. It's only 5% of the losses, but it's 30% of your income. And that's what insurance companies are doing. And that's what he's saying here. You're trying to figure out if this firm's profitable or not. And you got this massive estimate over the next 20 years of what they think they're going to pay out. And that number needs to be accurate. Actuary majors, do you know there's a function called reserve actuaries? Have you ever heard that term? Any actuaries? Anybody knows what a reserve actuary is? So there's actuaries at USA. Her name was Mary, the one I worked with. Mary was USA's reserve actuary. She's probably retired by now, I guess. But that was her whole job, was to come up with these reserves. Very impressive person, very, very smart person, and a precise stickler for details kind of person. She wanted that reserve exactly right. So I don't know what she did all month long, because she did the reserves at the end of the month. I'm sure they did a lot of studies to try to figure out where would they make mistake in a reserve and those kind of things. So it's a huge part of the insurance business, and it's a huge part of their net income. You're really dependent on that forecast that they're making. You know how bad we are at forecasts, so they got to make this forecast out. Can you imagine with asbestos how difficult that is? Because you gotta figure it out for people who haven't even got diagnosed yet. Geico got into huge trouble in the early 70s. This is before he owned them. In fact, the industry is quite upset that they bailed Geico out in the 70s just so Warren Buffett could come eat their lunch, because they had under reserve for several years. So they're essentially misstating their net income. The company sailed blissfully along, underpricing its products. So he's saying there's two things here. Your stockholders think you're more profitable than you are, but also you're using those estimates to price your premium. And until you find out the true number, you're underpricing your product. So it's pretty serious. When it becomes evident that reserves at past reporting dates understated, then insurance companies do what's called loss development. That sounds really good, but it's not loss development. It's, oops, we made a mistake. Usually we under reserve. We loss development. Loss development you can reduce the other ways. Well, these shortfalls penalize reported earnings because the catch-up costs from prior years must be added to current year costs. This is what happened in 2001, a staggering $800 million of losses that actually occurred in early years, but were not recorded, were belatedly recognized last year and charged against current earnings. He calls it a mistake. Was it really a mistake? Can you tell someone who's forecasting 10, 20 years that they made a mistake? Maybe. It could have been perfectly good forecast, but just unknown future. So he's saying the mistake was an honest one, the forecast was a good one, but just had some, unknown stuff in it. For several years, this understated reserving caused us to believe that our costs were much lower. The overstated profit figures led us to pay substantially increased compensation. So there's the third thing, they're overpaying their employees. So this is something you have to watch out for. It's a big debate between actuaries and accountants. We'll see it when we do Schedule P. The accountants just focus on the current year and say, wow, we had a great year. And the actuaries say, no, we didn't have a great year. We had a much better year 4 years ago. We just figured it out this year, and it's going through this year's net income. So no, we didn't have a good year. And the accountants say, yeah, we had a good year. Look at net income. So it's this big debate. So you'll see actuaries are focused on accident year. Which product does this, which year does this belong to, regardless of which accounting year it goes through? Accountants are focused on accounting years, fiscal years. So you can get these disruptions, and we'll see it when we do Schedule P. You can see how material it is. We recommend scrapping the term loss development and reserve strengthening. That one even sounds better. What is reserve strengthening? That means you under reserved, you got to add more to your reserves. It's not reserve strengthening. It's making up for past mistakes. Loss development suggests that investors that some natural uncontrollable event has occurred in current year. Reserve strengthening implies that adequate amounts have been further buttressed. The truth is that management made an error in estimation that in turn produced an error in the earnings previously reported. The losses that developed, they were there all along. What developed was management's understanding of the losses, and really the loss reserving actuary. So I don't want to scare the actuaries to death, but if they mess up, the whole company goes under. Me as an accountant, if I messed up, no one cared. All right. The investment people, they can mess up. Usually wasn't too bad because there usually wasn't, unless, Silicon Valley Bank or something. They can mess up, but the actuary, if they mess up, the whole company is going under. So they're the most important person in the company, and they're the least understood because they have very mathematical jobs that people are like, I sure hope you know what you're doing, because if you don't, we're all done for, but we're not going to try to figure it out. So that's why I so appreciated Mary and just how stickler she was to making sure she did things right. It irritated me sometimes because I couldn't get numbers I wanted as fast as I would have liked. So a more forthright label would be lost costs we fail to recognize when they incurred, or just oops. Under reserving is a common and serious problem. So this is a key to what he's going to argue here. Why reserves should not be discounted. In his opinion, they're generally more understated than they're overstated. And so by discounting it, you're just making that worse. All right. So I disagree with him. You'll see, we're going to look at Allstate. I don't think you're going to see a general under reserving Allstate. Sometimes they're over, sometimes they're under. It's kind of a mix. And in fact, I think you're going to find, especially on the homeowners and auto insurance side, they tend to overdo it. So at USAA, Mary said she had a 3% cushion, which means she intentionally added another 3% on top of what she thought she needed. So on average, she's going to come in 3% lower. And so, and I think most insurance companies do that. So he's talking something that I didn't see in practice. So major under reserving is common in cases the company is struggling for survival. So maybe his point is, maybe the industry itself doesn't have a problem, but the firms that are about to go insolvent, they have a huge incentive. And you do have quite a bit of room to play with the numbers. And remember, if you got a $6 billion liability and you increase it, you change it to 5.8 billion, you just picked up $200 million in earnings. So you don't need much. And these are the type of firms that are struggling. They can almost name their net income by just having the actuaries fluff some things. Now you do have to have your reserves are audited by your external auditors. So they have actuaries. Y'all know audit firms have actuaries, right? So when audit firms audit insurance companies, they have actual actuaries who have worked for these companies. So they know what they're doing. It's not a bunch of accountants trying to figure out this complicated math. So they have to sign off on it, and they do quite a bit of work on that. But still, there's still a lot of room for disagreement. So a company experiencing financial difficulties seldom proves to be a tough grader, and so they've got an incentive to be a little loose. Let's see, where does he talk about? Yeah, this is kind of a strange story. It's kind of typical Buffett. A story about a fellow traveling abroad whose sister called to tell him that their father had died. The brother replied that it was impossible for him to get home for the funeral. He volunteered to shoulder the costs. The brother received a bill from the mortuary for $4,500 that he paid a month later. He got a $10 invoice, then he got another invoice, and his sister said, well, I buried him in a rented suit. So essentially what he's saying is, this is what the insurance industry does. Is they just keep adding more and more to the reserves over time. They were always there. It was always costing them better off if you just bought the suit and got it all done at once. But it's a typical strange story for Warren Buffett. But he's saying the insurance industry has these rented suits. They're just going to keep coming back to bite us. So here he talks about the discount because of this one-sided experience. So I think he's making the fallacy that he's arguing this is an incentive for firms struggling, and now he's applying it to the entire industry. And now he's saying reserves should not be discounted. There's no way, I don't think there's any way an asbestos writer cannot discount reserves because of that 40, 50 year issue. It's just going to be huge. So I don't agree with him on that. Auto insurance, homeowners insurance, yeah, not a big deal. These are 1 and 2 year products. It doesn't make that big of a difference. But so when you read this part, this is what he's talking about. These estimates actuaries are making that are huge to the company, but very, very, very uncertain. So the ultimate is what you have to do. You have to sit down today as an actuary and look out the next 10, 20, 30 years and figure out exactly what you're going to pay on this product by accident year. You look at each accident year, you stick that into the reserve, and then each year you update it. You'll see it when we get into Schedule P. I should show y'all Schedule P now because it's kind of clear, but you'll see Schedule P. We'll talk later how GAAP accounting versus statutory accounting, they have their pros and cons, but the big advantage of statutory accounting, which is hard to get your hands on, but the big advantage is the detail that you can get. It's an amazing amount of detail, including Schedule P. All right. Before we do workers' comp, there's one last thing I wanted to cover, and I don't know which. So I want to talk, and I'm probably going to step on somebody's toes. So y'all have your shoes on. I want to talk my second least favorite insurance product after dental insurance. I don't know. This might be worse than dental insurance. So title insurance. Any of y'all work in the title insurance industry? American Title? No, y'all seen them, right? There's like 2 of them. American Title and the other one, I can't remember. It starts with an R. Residential Title or something, I can't remember. All right, so what is title insurance? So first of all, you're not going to buy title insurance from USAA, and why is that? We're going to talk about that. Why can't USAA provide title insurance? Why is it there are only a couple players, and why are they so powerful and essentially own the regulations and the legislation on this industry? It's a really interesting topic. And is there a better way to do it? And is it possible that blockchain would be the solution? So we might talk a little bit about that. Could blockchains eliminate the entire need for title insurance? That would be pretty cool, right? How much is title insurance? Have y'all, any of y'all paid title insurance in here? Buy a house, title insurance, it's a few $100, right? Pretty expensive insurance. What are you getting for that? So let's look at it. Everybody has to have it. But what does it actually do? You're not going to get a mortgage on your house if you don't have title insurance. You're not going to sell your house to somebody else without doing this. So this guy, Scott Wilson. So here's a topic. You even pick your paper 2 topic. I think, Jamari, you might be the only one I've gotten. And Nicole was asking me, I don't know if you picked her, but it's Jamari's the only one that's told me so far, right? And I can't remember what you told me you were going to do, but it was a good topic, whatever you picked. So y'all need to let me know. But here's another opportunity. Title insurance is a very interesting topic, especially if you're in the blockchain and all that kind of thing. There are some places where they're saying, hey, we're going to document who owns this property, and that's what it is, and you don't need insurance. If this is what it says as the owner of the property, you don't have to worry about it. So this guy, Scott Wilson, might, if you wanted to do a title insurance paper, you could probably search on his name with the word title insurance and probably see some pretty good articles come up. So, he recently wrote that it's an easy way to rip off homeowners. So not exactly, he's kind of in my camp. He doesn't like it. Title insurance is a product that is designed to protect home buyers and mortgage lenders in case there is a problem or dispute over ownership of the property. Title insurance will then pay legal fees and compensate you if there's a problem. Have there's ever been this issue? Yeah, I've seen some documentaries on people who move into a house, buy it, and then the person who really owns the house shows up and they just got to leave. They have no choice. It's not like, hey, let's negotiate this. No, this is my house. Get out of my house. Title insurance is going to step in and compensate you. Now, the title companies do a little bit more than that. I have to admit, when I sold my mom's house, I was very impressed with the title company and what this lady did. First of all, she replied to emails at 3 a.m. That's kind of nice, right? You kind of like that. I don't mean she sent it at 3, to pretend like she sent it. I mean, she would actually email her and she emailed back at 3 a.m. It's pretty amazing. And plus my real estate broker and the title people, they were emailing each other back at 3 a.m. It was like, wow, you guys are really, really good. So, and what she would do is a lot of the kind of legwork and study to make sure we had clear title. So it's not like they just insure us. They also go out there, make sure the records are enforced. So we had an issue for ourselves because of the timing of a person passed away who was on the title, and when that happened and the timing, all that, it caused some issues. And the title company knew exactly what to do, what paperwork we needed, all of that kind of stuff. So it was helpful from that standpoint. That wasn't the insurance part though. That was the actual making sure we had good title before we transferred. Because obviously the buyer doesn't want to say, hey, the person who was on the title passed away and they've got some third cousin who's not to come claim the house, and y'all didn't, we get ours, some relative's going to come claim it. So I appreciated what she did. It made a lot of sense. It made it complicated, but I was glad she was there. But that's not the title insurance. It's part of every real estate transaction. You also pay for it when you're refinancing. This is the part I really hate. You keep paying that $500 over and over every time we refinance. You keep paying. It's like, what was wrong with the insurance we had before? Why are we doing it again? So it's ridiculous. There's a long list of what make a title defective, ranging from the previous owner didn't pay their taxes, so there could be a lien against it. Have y'all seen these stories about these people losing their houses for like a $200 city tax or something? I mean, it's just ridiculous to see how evil some of our politicians are, but pretty crazy. There can be disputes due to conflicting wills. That's part of what we had. When I sold my mom's house, the big issue for the title is, okay, there's only 4 obvious people who would have claims, and it's the 4 sons. So we can get the 4 sons to all sign that they don't have title. So that's essentially what she was looking for. Let's get all of them. So essentially what the title is like, who could be a possible claimant on this based on the person's will. You look at the will, oh, leaving everything to his wife. Okay, the wife's going to leave everything to her sons. Okay, if we can get the sons to all sign off, then we've got it. We got it made. So they ask questions. Really, it's about relatives. Who are all the relatives who could possibly have a claim on this? I wasn't too worried. The place where this house was this big open field, and one construction company bought the whole thing and put houses up there. So if there are title issues, every house in that neighborhood had an issue. So I was like, it's not gonna be our problem. We're gonna sue the builder because, I wasn't that worried about it. And my parents were the only ones that owned that house. So is the original builder, they bought it. So I felt like, it wasn't that big of a dispute, whatever arise. A missing heir that suddenly appears and claims ownership. The fact is, those problems are very rare. In auto homeowners insurance, the loss ratio is about 70%. We saw that. For title insurance, the loss ratio is 5%. So if you spend $500 on title insurance, on average, the claims are going to be $25. Now, what do the title companies say? Well, we're doing a lot for you. in addition to paying those claims. So that's probably why, I mean, so she did a lot for me, but she also got paid for their services. So, you know, there's the insurance and there's a title company. So I felt like I paid her anyway. For the consumer, the main problem is you're paying too much. The consumer advocates say it would cost 50, or it should cost 50 to 75% less. They say big deal, it's only a few $100s, but a few $100s is a few $100s for something you shouldn't have to pay. One of the key things that needs to be addressed is kickbacks. There's a history in the title insurance industry of paying kickbacks to real estate agents, lenders, and builders. How do you know? Because you tell your real estate broker, can I find my own title company? And they get really, really mad. That's how you know there's something going on there. The consumer ends up paying for all of those kickbacks. It's an illegal practice and it's widespread. The consumer rarely chooses the title company that they are using. There aren't many choices anyway. If you're buying an existing home and you use the one your real estate agent chooses, if you're refinancing, it's the lender. If you're buying a new house, it's the builder. Federal law gives you the right to choose your own title insurance company, though sometimes the pressure is so heavy, it's hard for consumers to do anything about it. Can you shop around for title insurance? You can shop around. I was contacted by one woman that she and her husband shopped around and saved more than $1,000. They had to stand up to the real estate agent because she wanted them to go with her company. A $500,000 property in California. I don't think there is a $500,000 property in California anymore. So a small 2-bedroom condo. You could pay $1,000 to $2,000 for title insurance here, and yet in Iowa, where the government runs the title insurance program, you only pay $150. So Iowa is another place you can research for paper too. There are some states that are trying something different, and it's having an impact. So you know, there's certainly some alternative models there. Now, at the time this article was written, I was the only one, but it'd be interesting to see if anybody else is doing that. It's not quite as cheap as 150. There are some other fees, so it might be as much as 500, but the point is it's a third or quarter of the price you pay elsewhere. But the bigger question is, why isn't USA, State Farm, Farmers, why aren't they your title insurer? And he'll talk a little bit about that here. It's an entrenched system. The title insurance companies control the process. They control the laws. Other insurers, State Farm, Allstate, are not allowed by law to get into this business. So that's kind of interesting, isn't it? Do State Farm, Allstate, USA want to get in this business? I don't know. I wish I'd asked that while I was at USA. One of these days, I got to find one of you actuaries that become an actuary. Call me back in 5 years. Let's ask that question. Why aren't USA, State Farm, why aren't they lobbying to have this changed? So what's the solution? Several options have been proposed. One is the Iowa model, which is a government-run insurance. No kickbacks there. The price is lower. Another option is having lenders pay for lot title insurance. Therefore, the lenders could bring their buying power to force lower prices. The third option is opening up the market to other insurers, so there could be more competition. Yeah, competition is the key. There's just so few. Let's just see. I think you're gonna major title insurance companies. You're probably gonna recognize these. First American, that's the one I was trying to think of. Old Republic, I think I've seen them. Have y'all seen some of these names in San Antonio? I think there's one on 410 with the big sign out front, doesn't it? So 36%, 2/3 are these top two. It would take a tremendous amount of political will to make that happen because, like I said, it's an entrenched industry and they fight any kind of change. So we'll talk about this in our risk management class. There's a nature of human beings. When you have something to lose and someone else has something to gain, the person who has something to lose is going to fight a million times harder than the person who has something to gain. That's why it's so hard to get things changed. So these guys are going to fight a lot harder than USA and State Farm are going to fight to pick up this business. So it's just the way we are. I don't remember what I had in this article, but there are other articles out there. Should title insurance be reformed? Entitled to profit. In Texas, title insurance is a total scam. What do you think their opinion is? I didn't write that one. But, Texas title industry in need of reform. High title insurance costs first calls for return. So I don't think you'd have any trouble finding plenty of material for this. I would classify this as a topic for this class, even though this industry doesn't sell it as like a separate industry, because it certainly falls under this industry. Anyway, I didn't highlight this last article just to give you another one to see. There's his website. I don't know if he's still at the LA Times. I mean, his email. But that's even cooler. And I used to do this when I started. I don't know why I was so shy when I started, but I got in the habit of just picking up the phone and calling people who wrote articles. And I don't think I had but just one bad experience doing that. Most people have no problem talking to complete strangers, especially if you use the sobbing I'm a college student story. Most people, they like to help college students out. So yeah, I mean, just go for it. You find this guy, email him, say, hey, I saw a great article you had on title insurance. I'm curious if you have any newer research that you could share with me. I think that'd be pretty cool. Or would you come talk to my P&C class, whatever. So any questions on title insurance? Am I whetting anyone's appetite for paper 2 there? I think that'd be I think only one student has done that in the past on this particular topic, but I think it would work pretty well. All right. So where are we going to go from here? We're going to get into workers' comp. I'm probably going to let you out a little early tonight because I don't want to start a new topic with 15 minutes left. But workers' comp, have you ever heard of workers' comp? Sound familiar? So you'll all probably have coverage for workers' comp if you work for any kind of large employer. So one last irritation of mine is workers' comp. A big chunk of it is health insurance again. So you got health insurance from your employer, you have health insurance from your workers' comp, you have health insurance in your auto insurance policy. We're just health insurance to death. Workers' comp is almost always the exclusion. It's the primary coverage. So the first thing, if you call in for an insurance claim, the first thing they're going to ask is where you're on the job, whether it's auto related or, a health insurance claim, where are you on the job? If so, go to your employer, get your workers' comp. So we'll talk about this. You also have long-term disability and paid sick leave and these other things. And when does one start and the other stop? And what you're going to find is a lot of companies, from the employee standpoint, the employee doesn't really notice it. It all feels like just one big benefit. The employer makes a big difference. And why does it make a big difference? Because workers' comp is regulated at the state level, and all those other employee benefits are regulated by the federal government. So your employer has this big tug of war between the federal government and the states, but they also want a good program. They want to make it as seamless as possible for you as an employee, but at the same time, they've got to deal with these regulators. So we'll start there, and let me know your paper topic. I think my last email to you, I said I needed your paper topic. So Jamari's the only one getting my emails, I think. I prefer an email because I'll probably forget and I can type it in right now, but yeah. So yeah, just an email would be fine. I don't know, Jamari, how long did it take you to write your email? Was it like hours and hours? 5 minutes maybe? So yeah, just send me an email. I want to know the topic, especially if you have a topic I don't think will work, because I want to make sure you're not getting, or that's not appropriate. So I don't want you to write a paper on autonomous vehicles. It's a paper on autonomous vehicles impact on the insurance industry. So I want to make sure you're tied to the insurance industry.